Welcome to the Deep Dive, the show that takes your piles of information from articles to personal notes and distills them into the most important insights, all to get you well-informed, fast.
That's right. We cut through the noise, find those surprising facts, and connect the dots you might not have seen, with just enough humor, hopefully, to keep you hooked.
And today we're doing a very special deep dive. It's tailor-made, really, for those of you preparing for your professional insurance exams with the Chartered Insurance Institute.
Ah, yes, the CII exam.
Specifically, we're diving deep into the RO5 Financial Protection Unit. So now that you've read the study material, maybe had your training with Wiser Academy,
Good point.
this deep dive should help you pull together all those key learning points. Think of it as a final audio revision before your exam.
Yeah, absolutely. And we'd actually recommend you create further summary notes. Just write down the key points that you hear during this review. It really helps consolidate things. Our mission today, then, is to give you a focused audio overview of Chapter 3, State Benefits. We'll extract the core information you absolutely need to understand.
Especially for tackling those multiple choice questions.
Precisely. Getting you ready for those tricky questions on the exam.
Okay, sounds good. Let's unpack this and get you ready for exam success.
Let's do it.
So to kick us off, let's set the stage. When we talk about state benefits in the UK, what's their fundamental role in the whole financial protection landscape? And maybe more importantly for our listeners, how should we think about them from an exam perspective?
Right. Well, what's fascinating here, I think, is that while state benefits exist to provide a safety net, a basic one, their level is generally quite low. And this low level actually emphasizes the need for private financial provision.
Ah, okay. So the fact they aren't generous highlights why insurance is needed.
Exactly. From an exam standpoint, it's absolutely crucial to remember that financial advisors need to be aware of these benefits. Why? Well, it's to quantify a client's actual need for private insurance.
So you don't double insure.
Precisely. You don't want to insure the same need twice. Understanding the state baseline is key.
Okay. So if they're a safety net, what are some of the key limitations we need to be aware of? This sounds like a classic area where exam questions might try to, trip you up.
Oh, definitely. This raises a really important question. State benefits often just aren't sufficient to maintain a desired lifestyle if something goes wrong.
Right.
Plus, eligibility can be very tight. It often depends heavily on someone's national insurance contributions record.
So you can't just assume you'll get them.
No, not at all.
Yeah.
You can't necessarily rely on them for comprehensive cover. That's why private provision, insurance, pensions, savings becomes absolutely essential. The state offers a floor, but rarely the whole solution.
Got it. Now, the source material talks quite a bit about significant changes with the Welfare Reform Act 2012. This sounds really interesting for the exam. Can you walk us through the big shifts, particularly universal credit?
Absolutely. That act was a massive overhaul. It introduced the benefits cap, which we'll get into, and started the transition of loads of legacy benefits into one single payment, universal credit.
To simplify things, presumably.
That was the idea. Simplify, make it easier to understand, and, crucially, incentivize work. For new claimants, universal credit was fully rolled out by late 2018.
Okay.
But the much larger task of migrating existing claimants from those old benefits, well, that's still ongoing. It's expected to continue until late 2026, actually.
Wow, so quite a long transition.
It is. So for your exam, you really need to understand both the new universal credit system and the legacy benefits, because they still apply to millions of people.
Right. Okay. So let's dive a bit deeper into universal credit then. What exactly did it replace? Which benefits got swept in?
Okay, so universal credit is designed to replace 6 specific legacy benefits. That's income support, income-based job seekers allowance, or JSA.
The means-tested one.
Exactly. Then income-related employment and support allowance, ESA.
Got it.
Housing benefit, child tax credit, and working tax credit.
Okay, quite a list.
It is. And it's means-tested, as you said. Your income and savings directly affected, it's tax-free, and it's paid monthly.
Monthly, like a salary.
Yeah, reflecting how most people manage wages. For 2024-25, the standard amount for a single adult over 25 is $393.455 a month, plus potential extra elements for kids, disability, housing costs, etc.
Okay. And what about this benefit cap? How does that interact with universal credit and the other benefits? Sounds like a critical limit.
It is, absolutely. The benefit cap, introduced back in April 2013, sets a maximum total amount of benefit a household can receive.
And a household is?
Good question.
Yeah.
It's an individual, their partner if they have one, and any dependent children living with them.
Right.
The cap applies to the total income from universal credit, most main out-of-work benefits, housing benefit, child benefit, and child tax credit, all added together.
So it can really limit the total support.
It can. For 2024-25, the rates outside central London are $423.46 a week for couples or single parents, and $283.71 a week for single people with no kids. Central London rates are a bit higher.
Okay.
Now, crucially for your exam, certain benefits are excluded from the cap. This is really important.
Which ones?
Things like attendance allowance, disability living allowance, DLA, personal independence payment, PIP, and the universal credit element for those with limited capability for work and work-related activity. Also things like guardian's allowance, carer's allowance.
So mostly disability or care-related benefits.
Generally, yes. They're seen as covering specific extra costs. Oh, and there's also a grace period, up to 39 weeks if someone was employed for 52 weeks or more before claiming. That's another detail worth noting.
Okay, lots of detail there. Right, let's get into the specifics of some other benefit types. These will definitely pop up in exam questions, I imagine. First up, bereavement benefits. What's the main one to focus on now, especially with recent changes?
Yeah, the primary one, especially after changes in February 2023, is the Bereavement Support Payment, or BSP.
BSP?
It offers short-term, targeted support. For 2024-25, someone without dependent children gets a £2,500 lump sum, plus £100 a month for 18 months.
And if they have kids?
Then it's more. £3,500 lump sum, plus £350 monthly for 18 months. Important for the exam. BSP is paid tax-free, and critically, it is not included in the benefit cap assessment.
Oh, that's key. So it sits outside the cap.
Exactly. And it doesn't affect entitlement to contribution-based JSA or ESA either. It's distinct.
So what does this mean for someone who loses a partner then? Are the older benefits, like widowed parents' allowance, still relevant at all?
Well, this brings up a really critical point for the exam. If the partner died after February 9th, 2023.
That specific date.
Yes. And the claimant has no dependent children and is under 45, then generally no other bereavement benefits are payable. BSP is it.
Okay, so that date and the circumstances are vital.
Absolutely. And remember, those older benefits you mentioned, widowed parents allowance and bereavement allowance, they are subject to the overall benefit cap, unlike the new BSP. Big difference.
Right. Let's test that. Here's a practice question from the study material. Question 1. What benefits are available to one spouse or partner on the death of the other, assuming they have no children and meet requirements, if the partner died after February 9th, 2023? A. Widowed parents allowance. B. Bereavement support payment only. C. Bereavement allowance. D. Both bereavement support payment and widowed parents allowance.
Okay, based on what we just discussed, the correct answer has to be B. Bereavement support payment only.
Because of the date and no dependent children.
Precisely. For deaths after that date, in those specific circumstances, especially under 45, PSP is the main one. The older benefits generally don't apply. It really highlights how crucial those dates and criteria are.
Definitely one to watch out for. Okay, moving on to income-related benefits. What's the general rule for capital limits? This feels like another potential exam trap.
It is a common one. For working-age income-related benefits, the rule is quite strict. If you have capital over £16,000,
$16,000.
you're generally not eligible at all. Full stop. And if your savings are between £6,000 and £16,000, your benefit is reduced. It goes down by £1 a week for every £250 or even part of £250 you have in that band.
Right, the tariff income rule.
Exactly. And this means testing includes the capital of a spouse or civil partner if you live together. It's not just about the claimant.
Okay, so $6K lower limit, $16K upper limit. Got it.
Well,
now, statutory sick pay, SSP, always a good one for the exam. Who pays it and what are the key figures?
right, SSP. For 2024-25, the weekly rate is $116.75. To qualify, an employee needs gross earnings of at least 123 trills per week.
Okay, minimum earnings threshold.
Yes. And crucially, this is the classic exam point, SSP is paid by the employer.
Not the government.
No, the employer pays it for up to 28 weeks. If someone's still sick after 28 weeks, then they typically move on to claiming employment and support allowance from the state.
Okay, employer first, then potentially the state. Let's pause for another practice question on that exact point. Question 2. Who is responsible for paying statutory sick pay, SSP, to an eligible employee? A, the Department for Work and Pensions, DWP. B, the employer. C, the National Insurance Fund, DHM Revenue and Customs, HMRC.
Simple enough if you remember the rule. The answer is B, the employer.
Definitely a common point of confusion.
It really is.
Yeah.
So remember, SSP employer, up to 28 weeks.
Got it. Okay, now, employment and support allowance, ESA. You mentioned it before. It sounds like there are different sort of styles of ESA candidates need to know.
You're absolutely right. Similar to JSA, ESA has new style ESA and the older income-based ESA.
What's the difference?
Okay, new style ESA is contribution-based. Eligibility depends on your national insurance record. It's not means tested on income or capital,
Right.
but it is taxable income.
Taxable. Okay.
The older income-based ESA, though, doesn't depend on NICs. It is means tested, but it's not taxable. And this is one of the benefits being replaced by universal credit.
Ah, okay. So contribution-based versus income-based, taxable versus non-taxable. Key distinctions.
Absolutely. Examiners love to check if you know the difference. Also, within ESA, you need to be aware of the work-related activity group versus the support group. Different conditions, different expectations.
Right, depending on the severity of the illness or disability.
Exactly. It dictates the level of support and any requirements to engage in work-related activity.
Okay. What about benefits specifically related to disability? Personal independence payment, PIP, and disability living allowance, DLA, often come up. How do they fit in?
Right. So PIP, personal independence payment, largely replaced DLA for working age people. That's 16 up to state pension age. This started back in 2012.
Okay. PIP is the main one for adults now.
Generally, yes. And PIP is tax-free, it's not means-tested, and it's not based on your NI contributions. It looks at the impact of a condition, not the condition itself.
And it has different components.
Yes, a daily living component and a mobility component. Each has a standard and an enhanced rate for 2024-25. DLA still exists, though.
For who?
For children under 16, and for existing claimants who are already on it before PIP came in for their age group. Like PIP, DLA is tax-free and not means-tested.
Okay. And attendance allowance.
That's for people over state pension age who need personal care or supervision due to illness or disability. Again, tax-free, not means-tested.
And carer's allowance.
That's for people who spend a significant amount of time, at least 35 hours a week, caring for someone who's severely disabled and receiving DLA, PIP, or attendance allowance. Carer's allowance is taxable, though. That's an important distinction.
Right, so PIP, DLA, AA are non-taxable. Carer's allowance is taxable. Knowing the age ranges and means testing status seems key.
Absolutely. That's prime exam territory.
Okay, and child benefit. It's not as straightforward as it once was, is it? Seems more complex now.
You're right. It's not universal in practice anymore. Generally, child benefit is tax-free, paid weekly for each child under 16 or under 20 if they're in approved full-time education or training.
And the rates?
For 2024-25, it's £25.60 a week for the eldest or only child and £16.95 for each subsequent child.
But there's always a but.
There's this. The High-Income Child Benefit Charge, or HICBC, this is a big one for the exam.
How does that work?
If one partner in a household, doesn't have to be the parent, could be a step-parent living there, has an adjusted net income over £60,000.
60,000.
Then the charge applies. It claws back the child benefit gradually. By the time income reaches £80,000, the charge equals the full amount of the benefit, effectively wiping it out.
So it becomes means tested for higher earners, effectively.
Essentially, yes. Families can choose not to receive the payment to avoid the charge, although often it's still worth claiming to protect NI credits for a non-earning parent.
Good point. Okay, what about tax credits? The source material calls them legacy benefits.
Yes, definitely legacy now, both child tax credit, CTC, and working tax credit, WTC. For exam purposes, the key thing is they're being entirely phased out. They're being replaced by universal credit for working-age people and by pension credit for those over state pension age. They should be gone by April 6, 2025.
Okay. Anything specific to remember about them?
Maybe just the detail that CTC elements for children born after April 6, 2017 are generally limited to the first two children in a family, unless exemptions apply. That reflects a policy shift.
Right, the two-child limit. Okay, finally, let's tackle state pensions. The new state pension from 2016 is obviously key, but we still need to know about the older schemes too, correct?
That's absolutely right. The new state pension, or NSP, came in April 2016. It replaced the old basic state pension and the additional state pensions, SRPS and S2P, for anyone reaching state pension age from that date on.
And how is it calculated?
Crucially, entitlement is based purely on an individual's own national insurance contribution record. That was a big change from the old system where you can sometimes derive benefits from a spouse's record.
Right. Is it taxed? Means tested?
It is taxable income, but it's not means tested. For 2024-25, the full weekly rate is £221.20. You generally need around 35 qualifying years of NI contributions for the full amount, with a minimum of 10 years for any payment.
Okay. And the legacy side, who's still under the old rules?
Anyone who reached state pension age before April 6, 2016, they get the basic state pension, which is lower, £169.50 a week in 2024-25, plus potentially extra from SERP-S or S2P based on their historic earnings and contributions.
And what about people who had built up SERP S2P but reached SPA after 2016?
Good question. When calculating their new state pension entitlement, there's a comparison made. They get the higher of what they would have got under the old rules, basic plus additional, or the new rules. If the old rules calculation was higher than the full NSP rate due to SERP S2P, they get the full NSP plus a protected payment for the difference.
So they don't lose out.
Exactly. Oh, and another key point?
Yeah.
You cannot contract out of the new state pension, unlike the old additional pensions.
Right. That link to workplace pensions changed. Okay, one last benefit. State pension credit. How does that fit into the picture?
State pension credit is a top-up for lower-income pensioners. It's means-tested, depending on age, income, and savings. It has two parts.
And
Guarantee credit, which tops up weekly income to a minimum level. This is the main part now. And savings credit, which is a legacy element.
legacy.
Yes, savings credit is only for those who reach state pension age before April 6, 2016. It was designed to provide a small extra amount for those who'd made modest savings for retirement. It's not available to new pensioners.
So guarantee credit is the ongoing bit. Savings credit is fading out.
Precisely. Knowing the difference and who might qualify for which is important.
Okay, this has been a really, really detailed look at state benefits. Covered a lot of ground there. For our final practice question, let's go back to basics, core definitions. Question 3. Which of the following statements best describes a contributory state benefit? A benefit paid regardless of the claimant's income or savings. B, a benefit dependent on the claimant's national insurance contribution record. C, a benefit that is paid by the employer. D, a benefit subject to the household benefit cap.
All right, thinking about the core types. The best answer here is definitely B. A contributory state benefit, like New Style JSA or ESA, or the state pension itself, means entitlement is directly linked to your national insurance contributions record.
It's about what you've paid in.
Exactly. It's not primarily about your current means, like income-related benefits, or paid by an employer like SSP. It's about the contributions. That's a fundamental concept to get locked down.
Wow, we really have covered a lot today, unpacking the intricate and constantly changing world of UK state benefits, universal credit, BSP, pensions. It's clear there's a huge amount to get your head around for the exam.
Indeed. And what's fascinating, I think, is how this constant evolution just underscores how dynamic financial protection is. Nailing these details, eligibility, means testing, tax rules, the cap, these are the nuggets that will really help you in that multiple choice exam.
They're the practical bits.
They really are.
So what does this all mean for you listening as a future insurance professional? Well, beyond just passing RO5, seeing how these benefits shift highlights the ongoing, absolutely essential need for good financial advice and for adaptable private provision.
Yeah, the landscape is never static, is it? So your learning shouldn't be either.
Keep those notes handy, keep asking questions. That deep understanding is really your best asset.
Absolutely. It's all about providing clear, insightful guidance in the end. Until next time, keep digging deeper into your understanding of financial protection.
You've been listening to The Deep Dive. We really hope this review has been a valuable step in your exam preparation. Good luck.